Hi everyone, Lucia Jr. here, CEO of Lucia Capital Group, and today I want to speak directly to you about the current volatility we're seeing in the markets, the broader changes happening in the world, and most importantly, why your personalized strategy is doing exactly what it's designed to do. So let's start with something big. Investor Ray Dalio calls this moment a big cycle, a rare period in history where major global systems like our monetary policy, political stability, and even world power dynamics are breaking down and reshaping. Now, these types of shifts bring change, maybe even a little anxiety. They also bring volatility. But here's the good news. You don't need to react because you've already planned for this. The bucket strategies are built exactly for this kind of moment. Over the decades that we've been doing this, we found that it helps to stop and review the facts of where the markets are. So that's what we're going to do today. So as of April 7th, the S&P 500 is down almost 14%. Growth stocks, they're down nearly 19%. But value stocks are down less, only around 7.5%. And international stocks, guess what? They're slightly up year to date. So not everything is moving in the same direction. And that's the power of diversification. If you're retired or close to it, you likely have a significant amount in fixed income investments in both your Bucket 1 and Bucket 2 portfolios. And this year, that's a good thing. U.S. aggregate bonds are up nearly 4%, corporates up 2.5%, and munis up over 1.5%. This is why we don't build portfolios based on all these crazy headlines. We build them based on time horizon and risk tolerance. Now, this chart shows the long-term growth of different asset classes from 1926 to today. Stocks have significantly outperformed bonds, bills, and inflation by a wide margin. But that growth comes with a cost, and you know what that cost is? It's called volatility. So let's talk about volatility. Pullbacks of 5 to 10% are totally normal. We see this about 3 of them every year. Doesn't seem that way, but we do. And corrections of 10 to 20%, they're also normal. We typically see 1 per year. This is part of how the market works. It just is. Even in years where the market finishes up, we often see drawdowns of 8%, 10%, or more. In fact, the average drawdown is 13.9%, which is about where we are today. Let's look back at 23 and 24. We saw drawdowns of 10 and 8.5% respectively, while both years resulted in strong performance. That's why volatility is just part of the journey, but it's not a reason to abandon your plan. And let's talk about emotions. Investors are emotionally wired to do the wrong thing at the wrong time for the wrong reasons. When the market goes up, people feel good and want to buy. And when it drops, they feel fear and want to sell. It's the opposite of what they should do. Emotions are powerful, and they often lead to poor decisions, unfortunately. And guess what? The data proves it. Because of emotional decision making, the average investor earns just 3.6% per year. It's not about access. It's not about intelligence. It's about discipline. That's why we built your bucket strategy. How about those that are trying to time the market? That's a risky endeavor. If you miss just 10 best days in the last 20 years, your return gets cut nearly in half. And most of those best days, they happen right after the worst ones. You don't win by guessing, you win by staying invested. And how about over a 1-year period? There's a 74% chance that the market is up. And over 15 years, I love this one, 100% statistical success rate. But to benefit, you have to stay in the game. And that's what your buckets allow you to do. And so let's revisit your bucket strategy, right? Bucket 1, that's our income now bucket, and that typically funds years 1 through 7 of income. We use cash and bonds and conservative income allocation, and this bucket funds your near-term needs. It's really your safety net. And bucket 2, that's our income later bucket, years 8 to 15, and we fund that typically with balance investments, including dividend stocks. And this bucket is designed in theory, to refill bucket 1 when bucket 1 is depleted. And bucket 3 is our long-term growth bucket, 15 years and beyond. This is where we invest in domestic and global stocks for long-term growth. This money gets time to grow because you just don't need to touch it. The structure is what lets you stay calm when the market isn't. And remember, since 1950, there's never been a 15-year time period where stocks, as measured by the S&P 500, hasn't produced a positive return. And also, depending on your plan, you may also have a lifetime income bucket designed to provide you with additional protected income from a life annuity. Or you may have alternative investments for further portfolio diversification. Not every client uses these, but when used appropriately, they add even more structure to your overall bucket strategy. So here's the important takeaway. If you have a personalized bucket strategy, let it do its job. The bucket strategy was designed for times like this. You don't need to guess. You don't need to worry about what the market does this month or next month or this year. You've already structured your portfolio to deliver income now and growth later. Now, if this message happened to be forwarded to you, or if you're not currently working with our team, this is your opportunity. Because without a strategy, selling investments in a downturn just to create income can do lasting damage to your retirement. It's called reverse dollar cost averaging, and it's one of the biggest risks retirees face. So here's what I want you to remember. Yes, there's a lot happening in the world today. Yes, volatility is back. Yes, things may feel uncertain, but you are not unprepared. You have a plan. You have a structure to that plan. You have a team behind you. And most importantly, you have a strategy that was built for times like this. We're here, we're adjusting where needed, and we're guiding you forward with confidence. And once again, thank you so much for your trust. And if you have any questions, please don't hesitate to reach out to your financial advisor. We're all in this together. Take care.